The U.S. auto market is undergoing a long-anticipated shift marked by significant month-over-month price declines. Various factors, including an unexpectedly high increase in supply, are contributing to more pronounced price cuts in the final weeks of 2023. After experiencing consistent growth for over a year, recent data indicates that the vehicle sector is now in a bear market. Conditions are becoming more favorable for buyers, despite facing the highest borrowing costs in decades, according to auto research firm Cox Automotive. But before we go any further, please make sure to subscribe to the channel with your notifications on, and leave a like below this video. In the second and third quarters, the market transitioned to a lower gear, and analysts now predict that an oversupply of vehicles will trigger a year-end price war, ultimately restoring affordability to somewhat normal levels. Since 2021, Americans have contended with elevated prices, reduced inventory, and more expensive auto loans compared to the last decade's averages. Although the current market appears discouraging, experts from Cox Automotive, the owner of the closely followed Manheim Vehicle Value Price Index, suggest a positive outlook. Wholesale prices have continued to drop, with dealers paying almost 2.3% less for vehicles at auction in the first 15 days of November. Wholesale prices have now decreased by 5.3%, driven by falling demand and increasing inventories. This downward trend is already in motion, as wholesale price drops typically translate into retail price drops within 6 to 8 weeks. Retail prices are already declining, with the Manheim Index of used vehicles officially entering a bear market with a 20% decline last month. The index's most significant drawdown in its history is gaining momentum, and the average used car price dropped to $26,533 in October, nearly $3,300 lower than its peak. While new car prices have been improving for months, the average new car price was revised downwards to $47,700 last month due to industry-wide discounts and concerns about the auto worker strike. The index also reveals that big trucks are selling for about 4.2% less at auction, SUVs for 4.8% less, compact cars down 10.7%, and mid-size cars about 8%. Overall, the difference in average price between new and used cars has returned to 2019 levels. While this is positive news for buyers seeking relief after almost 2 years, it also signals financial losses for manufacturers. UBS estimates a 6% excess in car production over sales this year, resulting in a surplus of 5 million cars, requiring substantial price cuts to be sold by year-end. Some price cuts have already occurred, with electric vehicle makers Lucid and Tesla reducing popular model prices by nearly $20,000. Despite bullish production schedules, there is a high risk of overproduction and growing pricing pressure, as indicated by a note to clients from UPS. New vehicle price inflation is expected to disappear, with sales plummeting in recent months, and even a production slowdown has not prevented rising new vehicle inventories for the big three U.S. carmakers. This has led to a stock decline and revived concerns about a potential car market crash with an inventory surplus. The U.S. car industry seems to have avoided a situation where lower inventories would lead to higher prices, which may have been a consequence of a more prolonged strike, according to Deutsche Bank analyst Emmanuel Rosner. Instead, the rising inventories are resulting in lower prices, putting many companies in a challenging financial position. Last week, Mazda reported its first sales declines of 2023, while Toyota, Kia, and Hyundai had their smallest gains of the year. Ford also disclosed an overall sales drop of 5.4%, with truck sales declining by 10.5%. Sales of the Bronco, affected by the strike halting production at the Michigan plant, plummeted by 56%, as reported by Ford. General Motors and other carmakers opted not to release their latest numbers, indicating potential issues with their balance sheets. Executives often shift from monthly to quarterly reports when they aim to avoid alarming investors about revenue problems. New updates are expected in early January, suggesting that automakers are now focused on next month's sales to offset their losses. Ford and General Motors shares have hit unusual lows, with Ford's stock down approximately 13.3% year-to-date and GM's down by 15%, in contrast to gains of around 12% for the S&P 500 index in the same period. The bear market and the growing disparity between supply and demand are likely to worsen their challenges in the coming months. The only way to address the slowdown in auto sales is by offering even deeper discounts to move inventory off lots. While improvements are expected on the pricing front, the same cannot be said for financing. Bankrate data reveals that average borrowing rates for vehicles have surged from about 3.85% in February 2022 to 7.3% this week. This rate shock is likely to continue restraining demand, especially considering that millions of Americans are still priced out of the market at the current high rates. Car loan costs reached their highest level since 2017 due to the Federal Reserve's anti-inflation interest rate hikes. In October, the average car loan charged 11.6%, up from 11.1% in July, according to Edmunds. Moreover, the average car payment for new vehicles has reached a high of $725. As a result, the United States is currently grappling with the most severe automotive loan crisis since the Great Recession. A notable and concerning development within this crisis is the unprecedented surge in Americans searching for Give Car Back on Google in recent weeks. This trend was first identified by automotive market observers at Car Dealership Guide on X, formerly known as Twitter. The surge in these searches indicates that more individuals are experiencing car repossessions due to defaulting on their car loans. Simultaneously, others are seeking ways to get rid of their vehicles to minimize potential losses as they find themselves underwater on their loans. The volume of new car loans has surged since the onset of the pandemic, making auto loan debt the third largest debt category for Americans, following mortgages and student loans, according to the Federal Reserve Bank of New York. Oxford economics analysts caution that the primary factor driving auto prices down will be the increasing headwinds to demand, primarily attributed to high interest rates and tightening lending conditions. They also anticipate a modest rise in the unemployment rate in the coming quarters, further contributing to weakened demand. The analysts forecast a significant downturn in the automobile sector in the fourth quarter, with sales remaining sluggish through the first half of 2021. Manufacturers and dealerships are now in panic mode ahead of the holiday season, driven by the urgency to clear out their inventory before the year end. This urgency may lead to a race to the bottom, resulting in a potentially grim downturn for the industry. To make room for incoming 2024 models, automobile makers and dealerships are motivated to sell their remaining 2023 models, as unsold cars on the lot continue to accrue costs in terms of dealership expenses and borrowing costs. The pressure to meet sales goals and maximize profits in the final quarter of the year is palpable for car makers and dealerships. As a response, they are likely to offer more attractive financing options to entice buyers, especially during the holiday season. With approximately 6 weeks left before the end of the year, the final quarter carries extra weight, making it crucial for businesses to sell every available vehicle. Experts anticipate a slowdown in the sharp declines observed throughout the year, with Black Friday marking the start of the season, featuring discounts ranging from 25% to up to 40% on oversupplied models. Car buyers are encouraged to take advantage of new car deals with exceptionally low interest rates during this period. Conversely, there is a potential for used car prices to experience a more pronounced drop as more consumers turn to the new vehicle market. When demand falls, prices follow suit, and in this case, they may drop more abruptly than anticipated as companies seek to bolster their financial results, mitigate losses, and divert attention from the unfolding crisis in the sector. While there may be some short-term gains, the situation remains complex, and the impact on the automotive industry is unfolding. The audience is encouraged to share their experiences and insights, and the discussion will be eagerly anticipated. Thank you for watching. Make sure to subscribe and leave a like below this video.